You are staring at your bank app at 11:47 p.m. Not because you're checking on anything exciting. You're checking because you do this every night. You already know what you're going to see. The number hasn't moved much. Maybe it went up a little from your last paycheck. Maybe it went down because something unexpected happened. It always does. And you close the app. You open it again 30 seconds later. Like somehow the number is going to be different. Here's what nobody tells you. That habit, that anxious, compulsive, nightly check is not a sign that you're bad with money. It is actually the first sign of financial awareness. It means you care. The problem isn't that you're checking. The problem is you have no idea what to do with what you're seeing. And that is exactly what we're going to fix today. Hi, you can call me Miss Money, and I spend way too much time thinking about how ordinary people build extraordinary financial lives with no head start, no inheritance, and no one in their corner explaining how any of this actually works. If you're someone who is working hard, making some money, but somehow still feel like you're running in place financially, like the gap between where you are and where you want to be just isn't closing, make sure you hit the subscribe button and give this video a thumbs up if this helps you out. Because today, I want to walk you through something that I genuinely believe has the power to change your financial trajectory. Not a get-rich scheme. Not some viral side hustle. I want to talk about how someone, a completely ordinary person, can go from $847 in savings to a net worth of over $1 million. And I want to show you exactly how it happens, step by step, decision by decision. Because when you see the full picture, you will realize that this is not about talent. It is not about luck. It is about a very specific sequence of choices that anyone can make. Let me paint you a picture. Imagine a woman, we'll call her Adiz, who works in logistics, tracking freight invoices on a cracked monitor in a windowless back office. She pulls double shifts. The desk is the same every day. The paycheck is the same every month. Nothing moves. One Tuesday, an envelope arrives. She knows before she even opens it, her mother's medical bill. $11,400. Her savings account holds $847. She has been staring at versions of this situation for years. And she is not in a panic anymore because panic stopped moving her a long time ago. But she's not numb either. She is watching. She is thinking. And she has started to understand something that most people in her situation never figure out. Money is not a destination. It is a system. And systems can be entered from any door. Now here's the thing. Most of us, when we're in Adiz's position, do one of two things. We either catastrophize and freeze, or we distract ourselves and pretend everything is fine. What Adiz does is neither. She opens a brokerage account with $200. $200. It feels absurd. She does it anyway. Now, you might be thinking, what is $200 going to do? And honestly, in the short term, almost nothing. The math is not impressive yet. But I want you to understand something about the psychology of that moment. Because this is where most people misunderstand how wealth building actually starts.
It is not about the amount.
It is about the decision to begin. Because beginning, actually moving, rewires something in your brain. It shifts your identity from, I am someone who can invest to, I am someone who invests. And that identity shift changes every decision you make after it. She buys fractional shares of an index fund. She automates the investment before she can spend it. And this is critical. She is not trying to time the market. She is not picking stocks. She is not watching finance YouTube for stock tips. She is doing the most boring, most powerful thing in personal finance, staying in the market consistently over time. Here's what most people don't realize about index fund investing. According to data going back over a century, the S&P 500 has delivered an average annual return of roughly 10% before inflation. That means if you invest $200 today and never add another cent, in 30 years, at 10% average annual growth, that $200 becomes approximately $3,490. But what if you automate $200 every single month? Over 30 years at 10% annual return, you're looking at roughly $452,000. From $200 a month. Now she's not making that kind of contribution yet. But she has started the clock. And in wealth building, starting the clock early is worth more than almost any other decision you can make. A study from JP Morgan Asset Management found that missing just the 10 best trading days in the market over a 20-year period cuts your returns nearly in half. The people who miss those best days are almost always the people who tried to time the market, got scared, and pulled out. Adiz doesn't pull out.
She stays in.
But she also knows that $200 a month is not going to solve a $11,400 medical bill. So she does something else. She picks up a second job, weekend bookkeeping for a small construction company. $400 a month, cash. The owner, a blunt man named Goran, has no idea what his actual profit margins are. Adiz finds out within one weekend of looking at his books. He is losing 11% on 2 of his 5 contracts. Miscategorized material costs. She tells him directly. He looks at her like she's accused him of something. Then he writes her a bonus check. This is where I want to pause because this is not just a nice story moment. This is a lesson. Adiz did not go to Goran with a polished presentation. She did not negotiate for a higher rate. She just did the work competently, saw something important, and said it plainly without ego. And that exact behavior is what opens every door in her financial life going forward. Competence, without ego at the entry level opens doors people never expect. Goran introduces her to his accountant. The accountant refers her to a property developer. One door opens into the next. That is always how it works. Now, while all of this is happening, Adiz is tracking her mother's medical debt balance every single month, watching the number fall, slowly then faster. And here is the psychology behind why this matters. Research in behavioral economics, specifically work by Dr. Avni Shah and colleagues, shows that people who track debt repayment visually and regularly are significantly more likely to stay committed to it. Not because tracking magically creates money, but because it keeps the goal emotionally alive. It keeps it from feeling abstract. 14 months later, the debt is gone. She doesn't celebrate. I love this detail. She redirects every single dollar. The same $600 a month that was going to debt now flows directly into her investment accounts. This is a strategy called the debt-to-wealth redirect. You build the habit of sending that money somewhere before your lifestyle has time to expand to fill it. Because, and this is the trap that catches so many people, lifestyle inflation is silent. The moment you have a little more breathing room, your spending quietly expands. The coffee upgrades. The subscriptions add up. The I deserve this voice gets louder. Adiz mutes that voice. Not permanently. Not with suffering. She lives modestly but deliberately, and she redirects with precision. By 29, she has $18,000 invested. That number once felt impossible. Now it feels too small. And that is exactly the right feeling to have because it means the horizon has moved. Her sense of what is achievable has fundamentally changed. This is where it gets really interesting. Adiz studies for her real estate license on lunch breaks. Nobody knows. She doesn't tell anyone. She sits the exam on a Saturday morning, passes,
Returns to the office on Monday.
The license is hers, not a plan, a tool. She is waiting for the right problem to appear. And it does. Her client, the property developer she found through Goran's accountant, wants to offload a distressed duplex that no other agent will touch. Asking price, $74,000. It's in a transitional neighborhood. Conventional agents won't go near it. Adiz walks the property herself. She brings a contractor she trusts. They go room by room. The structural issues are cosmetic. Verbal estimate, $9,000 in repairs. She negotiates the price down to $61,000 to close fast. Now she needs $61,000 she doesn't have. 3 lenders say no. The neighborhood flags their risk model. The property type triggers policy exclusions. She thanks each one and moves to the next. Here is what the average person does at this point. They take the 3 rejections as an answer and walk away. Here is what Adiz does. She finds a community credit union. She brings 2 years of clean financial documentation. Income documented. History clean. Approved. Mortgage, $440 a month. She charges $650 per unit. After insurance and maintenance reserves, she nets $580 a month. Month 7, a tenant stops paying. She sends the first notice. No emotion, just process. She files the eviction herself. She handles every part of it: property manager, lease drafter, repair coordinator, without resentment. Why am I telling you this part? Because this is where most first-time real estate investors quit. The first difficult tenant. The first late payment. The first moment the passive income dream feels like anything but passive. And they sell. They walk away. They say, real estate isn't for me. But here's the thing. Real estate was never meant to be passive at the beginning. It is an active, hands-on, skill-building phase. The passive part comes later, after you have built the systems, the knowledge, the relationships, and the reserves to handle problems without them becoming crises. Adiz doesn't quit. By 31, she owns 3 rental units. None of them are impressive. All of them cash flow. Comment doors in the comment section if you're starting to see how every decision she made opened the next one. At 31, she also has $41,000 in index funds. The compounding has been working quietly for 4 years. She keeps $12,000 in a high-yield savings account as an emergency buffer. She never touches it. A colleague asks her how she built what she has. She tells him, lower your expenses, automate your investments, acquire cash-flowing assets, and never mistake being busy for making progress. He nods like she's given him a riddle. Most people do. Here is what most people don't realize. The gap between someone who builds wealth and someone who doesn't is almost never income. According to a study by the National Bureau of Economic Research, the savings rate, the percentage of income you keep and deploy, is a stronger predictor of long-term wealth than income level. There are people earning $200,000 a year who are financially fragile. There are people earning $40,000 a year who are quietly building wealth. The variable is not the size of the paycheck. It is the discipline of the redirect. Adiz earns a modest salary, but her redirect rate is relentless. At 34, a private equity firm reaches out. For people, distressed commercial assets, secondary markets. They don't want her money. They've seen her rental portfolio. They want her eye for value. They offer her 10% carried interest on every deal she sources. Carry is not a salary. It is a share of the upside when a deal succeeds. She researches secondary markets on weekends, vacancy rates, anchor losses, carrying costs. And she finds it, a vacant strip mall. The anchor tenant left 18 months ago. The owner is bleeding. Assessed at $1.2 million. Carrying costs of $14,000 a month. The owner needs out. Adiz models the repositioning. 2 medical clinics, a pharmacy, a regional grocery. Post-stabilization net operating income, $180,000 a year. She presents this to the firm. They acquire the property for $890,000. 2 years of repositioning. Every tenant she projected moves in. The model holds. The firm sells for $2.1 million. Her carried interest, $121,000. She has never seen a number this large with her name on it. She doesn't buy a car. She doesn't celebrate. She sits with the number for exactly 1 hour. Then she deploys $80,000 into a self-directed IRA, entering a private bridge lending deal at 10% annualized. The capital works while she sleeps. She holds $41,000 in reserve because markets will move against her eventually. They always do. At 37, Adiz is no longer an employee. She has an LLC, 2 active deal relationships, 7 rental units across 2 states, and a brokerage account that crossed $200,000 last quarter. The compounding that started with $200 is showing now. At 40, her net worth crosses $1.1 million. She checks the number on a Tuesday morning. She hasn't told a single person. Not friends. Not family. Nobody needs to know this yet. And then she does something that I think is one of the most quietly powerful things in this entire story. Her mother's care is covered. That was the reason she started. She doesn't let herself forget it. Her sister receives $15,000, documented as an interest-free loan. On her sister's 30th birthday, Adiz logs in and quietly forgives it. Her sister will never know she did. That is what generational wealth actually looks like. It is not a flashy moment. It is a quiet transfer of security to the people you love, made possible by years of unglamorous, consistent, intentional decisions. She hires a fee-only financial planner. Not because she doesn't understand her finances, she understands them extremely well. She hires one because wisdom at this level means knowing the difference between knowing something and still having blind spots. The planner flags a trust structure she hadn't considered. Depreciation alone reduces her taxable income by $38,000 a year. Rental units inside LLCs inside a holding company. Investment accounts separated by time horizon, taxable, tax-deferred, tax-free. A family trust built now, before it's obvious she needs it. Because generational wealth is not an inheritance strategy. It is a structural one. You build it before it is obvious. And here's the part that I want to leave you with. By 43, Adiz is sitting in a room with 4 other principals on an $18 million deal. Her co-investment is $400,000, precisely within her self-imposed ceiling of 22% of liquid capital. She runs the downside scenario twice. It is survivable. That is the only question that ever matters. Is the downside survivable? A credit event triggers overnight in a European banking corridor. Commercial lending tightens. 2 tenants are subsidiaries of a retailer that just filed for bankruptcy. The refinancing window she planned for may close. She is on a call with her lender at 6:47 in the morning. She is already modeling 3 alternative scenarios. That is not panic. That is preparation. And it looks exactly the same from the outside. So, what is the actual takeaway from Adiz's story? It starts with a decision to begin, not when conditions are perfect, but now with whatever is available. It is built through ruthless redirection of every dollar freed up from debt. It is accelerated by acquiring assets that produce income even when you are not working. It is protected by structure, legal, financial, relational structure that most people never build because they don't think they're there yet. And it is sustained by one habit that no one talks about enough, the habit of running the downside scenario. Not to scare yourself out of action, but so that when something goes wrong, and something always goes wrong, you are not surprised. You are already 3 moves ahead. Here is your actionable starting point. This week, open one account you have been putting off. A brokerage account, a high-yield savings account, even a dedicated envelope for your emergency fund. Not because the amount is impressive, because the decision is. Comment doors in the comment section if you're going to take that step this week. I want to see you there. The market opens again tomorrow, indifferent to everything you have built. It asks only one question. What do you do next? You already know the answer. I'm Miss Money, and I'll see you in the next one.